Bitcoin is one of the fastest growing assets of all time. So what's the reason a large majority of people still ignore the asset that could make them so rich they'd never have to work another day in their life again? Looking for the answer to this question, I found one thing standing between people living paycheck to paycheck for the rest of their lives and making so much money with Bitcoin that their biggest problem is having to choose what luxury brand sweatshirt their poodle should wear today. So in this video, I'm going to review what this thing is, how you can know if you're making the same mistake, and I'm also going to give you a super simple way to overcome it that can help you make a tremendous amount of money with Bitcoin. Hi, my name is David. I'm the founder of My Bitcoin Academy, and I've been helping everyday people get into Bitcoin since 2018. So, how many people are still missing out on Bitcoin today? Knowing so would be a great way to determine how early we are and therefore if you could still make a lot of money by starting with Bitcoin today. It certainly feels like the whole world has already heard about Bitcoin. So how can we know how many people actually own it? As it turns out, we can't. Because even though the Bitcoin blockchain is a completely open ledger that anyone with a smartphone can look at,
hey, that's cool.
It even lists the exact amount of Bitcoin in every account down to 8 digits of precision. Yet, these accounts aren't publicly labeled with the names of their owners. All we can see are addresses that look like these long random alphabet soup strings.
BC1QVS2RD4ZCR. I can't even read this.
And even though we know there are 54 million non-zero Bitcoin addresses, tens of millions of people keep their Bitcoin on an exchange. So even if we see only a few accounts holding billions of dollars worth of Bitcoin, these represent millions and millions of Bitcoin owners. That means we can't figure out how many people own Bitcoin just by looking at the public record. Why does it have to be so difficult? Luckily, there is another solution. Multiple analysts in the Bitcoin space have tried to estimate the total global adoption. I had a look at their findings and the results may amaze you. But before I tell you what they found, I also asked my followers on X what they thought. And to my surprise, most thought there were less than 100 million Bitcoin owners in the world. But the most recent estimates show the real number lies somewhere between 2 and 300 million Bitcoin owners. Sounds like a lot, right? Well, it isn't, and I'll show you why with these 100 oranges. Let's say each orange represents 80 million people. If we're generous and we assume there are 300 million Bitcoin owners in the world, that means that 4 oranges represent all of the Bitcoin owners in the world. So the 96 remaining oranges, those are all the people with no Bitcoin. And with 8 billion people living in the world today, that means 96% of all of the people in the world still have no Bitcoin. That's how early we are in Bitcoin's global adoption story. And if these people with no Bitcoin aren't careful, they risk getting squeezed. Now, why is virtually nobody buying Bitcoin? Maybe because they don't know about it? Do you know anyone that's never heard about Bitcoin? Of course not. Bitcoin is one of the biggest brands in the world, up there with Apple, Google, and Coca-Cola. Not bad for an internet protocol with a bunch of nerds as its marketing department.
If you don't have any Bitcoin, you are very poor.
Now, do you want to hear something mind-blowing? This will help explain why most people aren't buying Bitcoin yet. People with damage in the areas of the brain generating emotions find it really difficult to make decisions. Simple tasks like choosing what clothes to wear or what to eat for dinner can literally be impossible for people with brain injury to the part of the brain that controls emotions. No. I'm not saying people who aren't buying Bitcoin suffer from brain damage. Okay, maybe just a little bit? Seriously though, all I'm saying is that even though we think we make decisions rationally, in reality, most of our decisions are based on emotions. Emotion is the reason you grab a snack at the checkout counter. It's why you pull out your phone whenever you're bored. It's why you procrastinate when you need to work. Research has shown that if your emotional brain circuitry doesn't work, you're incapable of making proper decisions. About 95% of our decisions are influenced by our body's emotional responses to the situations we encounter. And this is why people aren't buying Bitcoin, because of emotion. In particular, because of fear. Fear of the unknown, fear of uncertainty, and fear of losing money. Now, how can you tell whether you too have allowed your emotions to control you? Last time you decided not to buy any Bitcoin. I'm going to show you a simple technique to help you with that. You would say figuring this out should be easy, but if it really were, no one would ever mess up a situation because their emotions got in the way. And I get it, Bitcoin is notorious for its extreme price swings. In a short period, the price can shoot up, but it can crash just as fast. And if that doesn't make you feel anything, maybe you're not even human. Hey, ChatGPT, what do you feel whenever the price of Bitcoin shoots up or crashes $10,000 in a single day?
I don't have any feelings because I am not a human.
Alright, so to know whether your decision was an emotional one, I've got 3 yes or no questions you can ask yourself. I need you to answer each by yes or no and say it loud enough so even your dog can hear you clearly. Number 1, am I acting impulsively or feeling strongly influenced by fear or excitement without clear logical reasoning? Yes or no? Number 2, is my decision being driven by other people's views or need to settle rather than my own goals and values? Yes or no? And number 3, can I clearly explain my thought process in a rational way so others can understand it? Yes or no? If you've answered yes to any of these questions, it means your decision was emotional rather than rational. Now, to help you remove fear from the equation and make better investment decisions, I'm going to share a very special tool with you. It's simple enough to explain in 2 minutes, yet so powerful that I wish I had known about it 11 years ago. But before I tell you what 96% of the world is still ignoring, let's ask ourselves, how should we deal with risk? Should we let our choices be guided through fear and completely avoid all risk? Let's think it through and see what a risk-free life would look like. Time to take a shower. No, that's too risky. I might slip and break my back. I'm hungry. Let's cook some food. But what if I cut myself or cause a fire?
Living in fear is clearly not an option. You would never get anything done. Instead, we should take calculated risks. As humans, we go out into the world continuously weighing the risks and benefits of everything we do. Risk may often be hard to quantify, but when it comes to investing, it's actually quite easy because we can use data. And this is where a fundamental factor comes in, one that can help you make one of the smartest investment decisions of your life.
It's the variable that professional investors use the most when deciding where to deploy their capital. It can immediately tell you if the risk of an investment is worth the potential returns. It's like having a GPS if you were captain of a ship. It helps you navigate the fastest and safest course to your destination. And it's called risk-adjusted return. With the risk-adjusted return, you can compare different investments to see which potential returns are most worth the risk. I won't go into much detail about calculating it. There are other great videos for that. All you need to know is that the Sharpe ratio is usually the best way to calculate the risk-adjusted return. The Sharpe ratio equals the rate of return minus the risk-free rate, divided by the standard deviation. Whoa, wait. Before you run away scared, trust me, it's simple. You don't even need to fully understand it to get massive benefits from it. Now, the return is just the average return of the asset over a certain period, 10% for example. The risk-free rate is usually the interest earned on a risk-free government bond, say 2.5%. And lastly, the standard deviation measures how much the asset price varies from its average. A more volatile asset has a higher standard deviation. A less volatile asset, a lower one. Let's take 5% as an example. Now we just plug in the numbers to find the Sharpe ratio. It equals 1.5. This means this example investment creates 1.5 times the returns for each unit of risk. The higher this number, the more an investment grows your money and the less it loses when it does. I cannot stress enough how powerful this is. You now have an effective way to compare assets with very different risk-reward profiles. Let's put it to the test and see how Bitcoin compares to a few other asset classes. Should you invest in a government bond that offers safe and predictable returns? Or rather in a stock market index with historically better returns but higher risk? And what about gold? To find out, let's compare the Sharpe ratio for long-dated US Treasuries, gold, the S&P 500 stock index fund, and Bitcoin. Let's go through them one by one. First, even though long-dated US Treasury bonds are supposed to be a safe and stable asset, they've been more volatile than gold in the last 10 years. Their returns have also been horrible. They don't even make up for the inflation rate. This is why bonds have the worst risk-adjusted return of the assets listed here. It's below zero. This is all due to money printing and interest rate manipulation by central banks. Now let's see how the other three compare against it. Gold has historically been viewed as a hedge against inflation, but its returns in the last decade have been low. A Sharpe ratio of 0.32 indicates that the returns have not sufficiently made up for its risk. Moving on, the S&P 500 has delivered strong returns with a decent Sharpe ratio of 0.62 over the last decade. It's had a good risk-return balance, making the S&P a solid investment for long-term investors looking to grow their wealth. Now finally, Bitcoin. We notice that Bitcoin's annual volatility is massive, almost nerve-wracking. But look at Bitcoin's returns over the last 10 years. 67.5% per year on average comes down to a total gain of 15,000%. Nice! Now, out of these four, can you spot the asset with the highest Sharpe ratio? Yes, of course, it's Bitcoin. Its monster gains more than make up for its volatility with a Sharpe ratio nearing 1. Bitcoin can have wild price swings in the short term, but its long-term returns more than justify the risk. In any 5-year period since its inception, Bitcoin's risk-adjusted return has crushed that of all other asset classes. So, from now on, you know what to do to become a better investor. You can overcome your irrational fear of Bitcoin by realizing that Bitcoin offers unbeatable risk-adjusted returns. You have the chance to buy Bitcoin before 96% do, and thereby benefit from the best risk-adjusted returns of any asset class. How big is your opportunity exactly? How much money could you actually make if you started buying Bitcoin today? Well, if you click this video up here, I'll show you exactly how to find out.